We come next to one of the best topics in the syllabus. The reason I say that is that there is a format. If you master the format and you can understand cash, I think most of us can. In other words, if you have a receipt of cash, it's called an inflow. If you pay cash, it's called an outflow. So a collection of receipts and payments, a collection of inflows and outflows is called the cash flow statement. Most of us can understand cash because there aren't any accruals and prepayments to trouble us. And indeed, the non-accountant user of accounts often assumes that the cash basis is what is used for accounting, and that's not quite right. So what does cash flows mean? If you turn please to session number 11, as I have on the screen, we can see how cash flow statements, nowadays known as statement of cash flows, work. It's IAS 7, International Accounting Standard number 7, of course. Have a read of that page, session number 11. So, learning and outcomes. When we have completed this chapter, we should be able to explain the purpose, let's underline purpose of producing a cash flow statement. That's one thing, of course. The second is the advantages of a cash flow statement. Explain the principles of the IAS, and of course, produce a cash flow statement. In the style of examination that we are facing, where you have 2-mark questions, clearly the various component parts that make up a huge cash flow statement are all individually examinable. So even though we will produce a huge cash flow statement, the build-up to it, in other words, why we do cash flow statements, how the system works, the cash basis as opposed to the accruals basis, that kind of thing, those are still highly, highly examinable. So even though we would like to do a cash flow statement and balance it, the ideas that build up to that cash flow statement, those are even more examinable in this new style of exam. So let's have a look at the introduction there. The cash flow statement is a primary financial statement and provides fundamental information to the user of accounts. So I'm going to highlight the word primary. Other primary statements, things like the statement of comprehensive income, the statement of financial position, the statement of changes in equity, and so you have the statement of cash flows. So it's like the fourth of the 4, all equally important. A primary and provides fundamental information to the user of the accounts. It highlights the key areas where a business has generated and spent physical cash. So let's highlight things like that. The word generated, spent, the actual cash, the notes. All of us can relate to cash. What else is there? Good cash management ensures a business has sufficient cash to run its day-to-day operations. Absolutely crucial, especially these days in an economic downturn. Prior to this session, we have focused on profit, but cash is equally vital for the success of a business. Cash, of course, is the lifeblood of a business. So, lifeblood of a business. Especially in the short term. If a business has limited cash funds available, it will struggle to survive in the short term, indeed in the long term as well. So extremely important to understand the importance of cash. Cash is what courses through the veins of a business, giving it strength. Shortage of cash, let's not think about. Though do be careful. In a question, you could have an overdraft situation. Let's read on. Advantages. Cash flow balances are a matter of fact and are not distorted by accounting policies. Now, if you think about something like depreciation, if a company decides to charge 12% depreciation instead of 10%, they can make their profit lower. Let's say if they would normally like to charge 12%, but this time they charge 10%, they can make their profit bigger. In other words, the income statement where profit is reported is almost like putty in the hands of a director, an unscrupulous director. In other words, you can squeeze it, release it, you can do what you like. Malleable, okay? So a director who has his or her eye on creative accounting can make profit what they want it to be. Whereas with cash flow, it's much more difficult, wouldn't you acknowledge? It's going to be very hard to say to your supplier, would you mind giving us the goods and taking payment after the year end because we want our cash flow statement to look good. Alternatively, we could say to our customers, can you pay in advance because we want lots of cash in the business and we'll give you the goods later. It's very hard to manipulate cash as it is to manipulate the income statement as indeed the expenses and profit. So that's where cash flow scores above the income statement. So that's the first advantage of cash flows. Another advantage, cash flow balances are objective, unlike profit, which is subjective, dependent on accounting policies. Whereas cash flow balances are a matter of fact, receipts, payments, factual. What else? The third one, users of financial statements can establish exactly the cash generation of a business. Clearly, if a company is cash rich, in other words, it's the difference between the income and expenses is a huge amount of cash. That is what a shareholder would like to see, one of the users of the accounts, the stakeholder, can establish the cash generation of a business by looking at the cash flow statement. Users can identify exactly how this cash has been utilized, not only how much cash it has generated through revenue, but what happens to it. Has it gone out as dividends? Is it reinvested as non-current assets, building a future for the company? That kind of thing. For example, if you've got loans standing at 10% and you want to repay them with cash and cut down the loan from 10% to 6% if you still need to borrow, clearly that would be a very good use of your cash. Repaying expensive loans and taking out cheaper loans, taking advantage of any interest rate reductions there may be on offer. All right, what else? Another one, users can assess the liquidity of a business, must underline that, liquidity of a business, and assess its ability to repay debts as they fall due. One of the problems, of course, in an economic downturn is that companies, individuals are unable to pay debts as they fall due. And so the lender comes along and takes away the business's asset, the individual's asset, the security, because, of course, the inability to pay as they fall due. There are certain time limits, certain dates on which, for example, debentures must be repaid. So the user can assess the liquidity of a business to see whether it's got enough cash to meet all these obligations. What else? Loans repaid and received are clearly listed in the cash flow statement, of course. Users can assess management attitude to capital expenditure. Are they in a situation of contraction? That is to say, are they selling off plant and machinery and not replacing it? Are they selling off a factory, say? Have they sold off a factory this year to help with their liquidity situation because they're short of cash? That kind of thing. So what is the management attitude to things like capital expenditure? Are they expanding? Are they building a future for the company by acquiring new assets, expanding the productive capacity. All that shows up in the investing section of our cash flow statement, as we will see. But more about that in a few minutes. Interest payments are highlighted in the cash flow statement, of course. So plenty there to go on, many, many advantages. The main issue, of course, is you can fiddle, you can abuse, you can use creative accounting for profit in your income statement and obviously ultimately in your statement of financial position. It's much harder to do that with cash. That is the bottom line. We turn our attention, therefore, to the IAS that governs all this, the IAS 7, International Standard Number 7. So let's turn our attention to that next. IAS 7 lays down the requirements of a cash flow statement. It gives us a detailed pro forma and certain definitions. So you must learn that pro forma. Learn by heart. Sorry about that, but you have to learn it by heart. Little sections of it will be examined repeatedly. So you must be completely relaxed about what is operating, what is investing, what is financing. There are three basic categories, as we will see in a few minutes. So it lays down the requirements of a cash flow statement and also gives us a detailed pro forma, a format. What's next? Cash is cash that is available on demand. Here are some definitions. An example would be cash in the bank less any overdraft. So don't forget to look for the overdraft when you're trying to work out the overall cash position. Cash equivalents, I'm going to mark that very important. That could be just the kind of thing that throws you in the exam. Short-term, highly liquid investments that will be showed as current assets in the balance sheet. So that's really the point, stated as current assets in the SFP. So if you've got investments that are shown as current asset investments, then you know it's a cash equivalent. IAS 7 has three main headings. We were saying we should be familiar with the layout of a cash flow statement. The three main headings, of course, operating, investing, financing. Operating, investing, financing. So I'm going to do a nice big O, I, F. Three headings. So in the last few minutes we've looked at what cash flow statements are trying to do, how superior they are in terms of keeping away from manipulation, creative accounting, superior to the income statement. So that's the first point, and of course the other point is, governed by IAS 7, you have this cash equivalence concept, which is short-term investments held as current assets. Those are meant to be cash. So cash and cash equivalents is what goes up or down to what we're trying to keep a grip on as we prepare this cash flow statement. Now, what I'd like you to do is to move on to the next page. So it's always for the year two. It's never as at. So that's the first point. It's always for the year two, never as at, unlike a statement of financial position. So similar, of course, to an income statement, statement of comprehensive income, things like the statement of changes in equity. This too is for the year. It's never as at. As at only belongs to the statement of financial position, because there's a financial photograph at that point in time. Now, this is a great format, this cash flow. You start with cash flows from operating activities, so that's a nice big O, operating activities. You start with profit before tax. The actual IAS gives you a little bit of leeway, but I would suggest in the exam be very clear that you are in fact following the IAS, and the IAS prefers if you start with profit before tax. So that's what we're going to start with. So it's all part of operating activities. Over the next little while, what I intend to do is to take you into the format, explain how the format works, why it works as it does, and then at some stage pick up a huge question and see if we can do it on a very comprehensive basis, writing on a blank sheet of paper the solution. So profit before tax, then you have adjustments for things like interest payable. Now, you notice the interest payable and depreciation is an add back. The profit or loss, basically the profit is a less, whereas the loss is an add back. So these adds, I mean add back, depreciation. Now, interest payable, you notice, is added back on the grounds that in arriving at your profit before tax, higher up the income statement, you would have charged some interest, whether paid or payable. Let's say the total interest that you charged in your income statement is what comes in here. So the word payable, probably I could use the word expense, meaning whatever went to the income statement. So that went to the income statement, the depreciation goes to the income statement, this goes to the income statement. So what you're doing basically is reversing what was done in the income statement. So here's a very, very important point indeed. We have to do the opposite of what was done in the income statement. So can I just say that here? This should be the opposite of income statement treatment. So I'm saying to you, please do the opposite of the income statement treatment. For example, if you have an interest expense in the income statement, it obviously was a charge. So the profit that we have here, the profit before tax, has suffered because of the charge. Okay? Now if I add it back, it isn't charged anymore. And later, I can show the actual interest paid. Do you see that? So whatever was done in the income statement, the interest expense, must be added back. Similarly, depreciation, because it doesn't involve cash. Depreciation is just a provision, doesn't actually involve cash being paid out. If you add it back, then later, once you've cancelled the earlier charge, so don't forget, when you add it back to your profit before tax, it's like cancelling what was earlier depreciated. You see? So once that's added back, the sheet is wiped clean, the slate is wiped clean, and of course the amount that you spend on buying new non-current assets, plant, etc., that can show up as an investing activity in brackets and outflow. Okay, so that's the crucial idea. The interest expense, the depreciation, etc., were earlier charged in arriving at profit before tax. By adding it back, it's no longer charged. What is this profit or loss on the disposal of a non-current asset? Let's say an item of plant. You've decided to sell it this year. Let's say it's in your books for 400 and you've sold it for 500. Would you agree in these circumstances you would have made a profit of 100? That profit would have been added in arriving at your profit before tax somewhere in your income statement. So perhaps the profit might have been reduced from admin expenses, that kind of thing. And so the admin expenses would have gone down, in which case your profit would have gone up. For whatever reason, or however you treat it, the profit on disposal of plant would have increased your profit before tax. Now do you notice that if you have a profit, you put it in brackets in our format, because obviously that bracket means it's going to be reduced. So that bracket, notice, it's an item in brackets like that. So because earlier it was added in arriving at profit before tax, if you deduct it now, it's like it was never added in the first place. It's been cancelled, negated. See, the effect of that has been eliminated. So earlier it was included as an addition. Now if you take it away, it's not there anymore. Similarly, if you have a loss on disposal of, say, some motor vehicles, the loss would have been charged in arriving at profit before tax. A charge means lower profit. If I now do the opposite of what was done in the income statement, in other words, instead of charging it, if I add it back, then it is as if it was never charged. And so we are writing on a clean slate the proceeds, money we got for selling those pieces of plant and the vehicles. Make that absolutely certain in your mind. Number one, how we do it. In other words, you add back interest, add back depreciation, add back loss. That's the first point. The second point is why we do it. And that will mean if you understand reasons for what we're doing, you'll never forget them, even under exam pressure. If you learn it mechanically, then there's always a risk under pressure, under time pressure, exam pressure, you might make a mistake. Reason out for yourself why we're doing the opposite of the income statement. And once you get that organized, this area of the question is a bit of a gift, to tell you the truth. So we come now to profit, operating profit before working capital changes. Not a compulsory heading, but a nice description all the same. So we come to our working capital changes next. Increase, decrease in inventories. Now, let's start with an increase in inventories. What does that mean? Let's say at the end of last year you had inventories of, say, 1,000 from the floor up, 1,000, and now the inventories have moved from 1,000 to 1,500. The additional 500 is something you spent money buying. And so you use a bracket to indicate that the increase in inventories means it's an outflow. Outflows are in brackets, inflows are without brackets. So let's concentrate on the fact that there may be an increase in inventories. That, of course, ends up as a bracketed item. Why is that? You had $1,000 worth of inventory, is now worth 1,500. The additional 500 is simply money you've spent to buy some more inventory. Hence the use of brackets is an outflow. Very, very straightforward. If, for example, the inventory goes down, let's say it was 1,500, now it's down to 1,000, it's easier to see almost that the additional 500, the drop, has now been converted from inventory into cash. Hence it's an inflow, and therefore you simply add to the rest of the cash flow statement. Notice the decrease in inventory appears as an unbracketed or inflow type of item. So inventory is very, very straightforward indeed. Let's turn our attention to receivables next. That is customers you've sold goods on credit to, and they have paid us or not paid us by the year end. So let's say in the first case you might have an increase in receivables. So let's go back to our little example earlier. Let's say at the year end you have 2,000 of receivables, but at the start of the year you had 1,200. So at the close of play you had 2,000, at the start of the year you had 1,200. So would you agree that the additional 800 must have been an increase in receivables this year? So last year you had 1,200, this year you have 2,000. You allowed it to increase by 800. You lost the opportunity of collecting cash. Hence it's a decrease. It's an outflow of cash. Okay? So an outflow of cash is a bracket. Of course, the word is an increase in receivables. I'll just run through that again. At the end of last year, you had 1,200. This year, you have 2,000. So didn't you allow the receivables to pile up? You lost the opportunity of getting cash. That is why it's shown as a bracket. Okay? Very, very similar to the treatment of inventories. So the concept of receivables is different to inventories. So an increase is a bracketed item, and as you can see there, it's also a bracket. Now, so if there's an increase in trade receivables, you did not collect that amount of cash, 800 or whatever. I wonder what would happen if it had gone down. For the sake of argument, let's say it was 2,000 at the start of the year and 1,200 at the end of the year. it's actually slightly easier to see that this time the 800 has been converted from receivables into cash. Do you follow that? So it's 2,000 at the start, 1,200 at the end. The other 800 must have been collected, converted from the receivables into received, which is obviously cash. So that is an inflow. So don't forget, bracketed means outflow, unbracketed means inflow. So the figures on the far right are only cash flow movements. The words on the far left are descriptions. And so sometimes the word increase, decrease may operate differently when it comes to cash flows, let's say between receivables and payables. So let's turn our attention therefore to a payable. A payable obviously is like a credit supplier. Let's say we've bought from someone outside, but they have, let's say, said to us, take your time paying. Don't bother to pay this year, pay next year. Let's say that were to happen. They want to do business with us maybe. Maybe we're very good customers of theirs. So if that were to happen, if there was an increase in creditors, in a sense they are financing us. It's a cheap source of finance because it's hardly ever charged any interest. So if there's an increase in payables, it means quite simply there's an inflow of cash. In other words, you've conserved cash, you saved some cash. And so if there's a decrease in payables, it means you've paid off some cash, so obviously that would go down. So an increase in payables is unbracketed, but a decrease in payables simply means it's an outflow, so I might highlight that one. So notice how it changes between increase and decrease. So they're opposites, obviously. I always found myself, when I first came across this years ago, even though the statement was called something slightly different, very similar, I always used to say to myself that if I understood how inventories worked, I could bounce my receivable idea off the inventory. It's exactly the same thing, both current assets, you see. And the payables, trade payables, I could do the opposite of what was done on inventory, because obviously it's a current liability as opposed to a current asset. So whatever system you have, whatever method you want to use, the important thing is to get the brackets or no brackets in the right place. The words on the left don't really matter what you say. Obviously it'd be nice to put some right figures down, but the crucial point is on the right, on the far right, you need to put it in brackets or no brackets. Especially with the computer-based exam, if you are going for that option, it's quite important to be able to say whether it's bracketed or not, whether it's an inflow or an outflow, and this particular topic lends itself very easily to examination. Any bits of it could be examined as lots and lots of little bits of 2 marks each. So do be careful of this. Right, what else can I say? Cash generated from operations is my running total. You then have your interest paid and tax paid. Notice the key word is paid. It's not payable. So if you come back with me a couple of inches, 10 minutes ago, we were talking about interest expense, which goes to the income statement. That figure is simply added back. So whatever was charged in the income statement, by adding it back, it's no longer in the cash flow statement anywhere, which enables me to come down here and say the interest paid, the outflow, is a bracketed figure because you've paid it off. Sometimes it is the same as the interest expense in the circumstance where you do not have any accruals or prepayment at the start or end of the year. But wherever you do have opening and closing accruals and prepayments, it's a wise technique to do the opposite of what was done in the income statement by adding it back. And with a clean slate, you now bring down or come down your page to this area and show the interest actually paid as a deduction, as an outflow. And then you have tax paid. Again, it's not payable, as a current liability or anything like that. It's actually the tax paid. You notice, of course, that higher up the page, our profit was before tax. Our profit was before tax. So clearly, if the profit is before tax, you don't have to make any adjustment in the adjustment section because it is before tax anyway. And so if that figure includes what will be paid as tax, the actual payment of that tax must be shown somewhere, and that is towards the end of the format, you see? Very, very straightforward indeed. Here we are, and that comes to, we come down to this figure, net cash from operating activities. I might do a little subtotal there. So there you are, that's the O under control. Operating. Operating, investing, financing. We've done the O out of the three. What's next, of course, is the investing, and then, of course, the financing. And it is to that we now turn our attention. So let's move on then to the net cash flow from investing activities and such like. The pro forma continued. Net cash from operating activities from the end of the previous page comes forward. It's just polite if you're doing a paper exam, or will do in time to come. It just is a good policy to help the market to understand how you've arrived at these balanced cash flow statements. So bring forward anything from the previous page. It's believed to be more professional. So we come to investing next. The I of OIF. The operating has been done. We're now doing the investing, and in a couple of minutes we'll do the financing. So what is investing? It's where you have the purchase of a non-current asset. So that's the amount paid. The purchase. So always assume these purchases are for cash unless told otherwise. The disposal of a non-current asset, that will have to be the proceeds. The proceeds received, which obviously is an inflow. The interest received and the dividend received. Be careful of these words received. The dividend received, the interest received, it mustn't be receivable, it's a receipt. That is to say, after any adjustments. How much was actually received as an inflow? Careful of that. We then come to our financing finally, OIF. Financing, quite simply, by the way, you have a total of the investing higher up, of course. We now have the financing, proceeds from the issue of shares. You will remember from our session on limited company accounts that if you issue shares at a premium, the cash flow, of course, the cash inflow, is not just the shares, the nominal value, but it's also the share premium. Don't ever forget that. The proceeds from the issue of shares, I'm going to say including any premium. Say including. So if we issue shares at a premium, let's say they're 50-cent nominal shares, nominal value of the shares, and you issue them at 80 cents, and if there are 200,000 shares being issued, you multiply 200,000 by 80 cents, 160,000 comes in here. In other words, the share capital and the share premium. Including is a key word. If it's a bonus issue of shares, obviously you might have to consider it in your working somewhere, but it should not feature in a cash flow statement because bonus means free, and the company didn't raise any new cash to invest. Be careful. Receipts of loans. The money coming in, I suppose, is what we need to report. The repayment of loans, as we were saying earlier, if you can repay a 10% loan and take out a 6% loan, so much the better. But that receipt of loans and repayments of loans, redemption of loans, must be shown as a cash inflow as a receipt. A repayment, of course, is an outflow. Therefore, it's in brackets. Then you have your dividends paid, and that comes from your SOSI. So, information from the statement of changes in equity. Our SFP, statement of financial position, the current liabilities, etc. So that's where all that comes in. So dividends paid. Again, if you feel it more convenient to do a little working, little T account working, whatever style, doesn't matter, that would be ideal. But if they give you a figure of dividend paid and you're able to work it out just by looking at the question, just drop it into this little slot. So you see how easy the whole thing is, especially if you think that we've come to the end. There's a bit of financing there. The net cash flow for the year is what that's supposed to be. And of course, the cash and cash, what's cash equivalents? You're right. Cash equivalents, of course, are current asset investments, investments held as current assets. Those are at the start of the year and at the end of the year, and of course the whole thing adds up. So if this year there's, say, a 2,000 cash inflow, if at the start of the year there was an 8,000, by the end of the year it'll be 2,000 plus 8,000, call it 10,000. So it's very, very, very straightforward indeed. So you've got to consider the beginning of the year and the end of the year. It's one of the great topics in the syllabus. The pity, of course, is that you will not get a huge cash flow statement to balance that comes up at the later stages of the exam, particularly a paper called F7, Financial Reporting, where the cash flow statement may be 2 pages long, and you will be asked to actually construct something that adds up. But let's be grateful for small questions as well. We can get quite a few marks by knowing our little principles. So that's not a bad position to be in either. So, may I invite you please to turn the page to the big question there called radiance. Radiance Europe. So, Radiance Limited, a huge question. Notice the direction in which we are going. We're producing the cash flow statement for the year 2007, which means the change between 2006 and 2007 is what we're after. So, what does it say? The non-current assets, cost minus depreciation, the net book value 102,128. So, seems like depreciation for the year is another 14, is it? Seems like. The non-current assets seem to have gone up by about 40. So that's gone up by 40. New non-current assets. There's a danger point here. Under the current assets, I noticed that there's, apart from inventory, which is easy, and trade receivables, there is, of course, bonds. So this is cash equivalents. Okay? So this is, the bonds is what we call cash equivalents. Meaning, of course, investments held as current assets. So there you have it, 129 and 181 is the running total, or the total of the top half of the balance sheet, SFP. The second half of the SFP, capital and reserves, share capital, that appears to have gone up by about 20. The share premium has gone up by 2 as we try to understand the question. Now, accumulated profits is particularly advanced in this question because no income statement is provided, therefore major workings are needed. No statement of comprehensive income provided by question, therefore workings needed to calculate, what was the first item in the cash flow statement? Was that profit before tax? That's the one. To calculate profit before tax. Okay, so that's going to be quite involved. Perhaps a special working is called for. Non-current liabilities is loan. I'm guessing that we've probably repaid about 10, would you say? If you're moving in this direction, if the 30 has become 20, I suppose we've repaid 10. That's quite easy. What else do we have? The current liabilities has payables and tax, and the whole SFP, of course, balances no problem whatsoever. We now come to some of these notes, which is where huge marks hide. The tax charge in the statement of comprehensive income is 6,000. So that goes obviously to the income statement, most definitely, or has gone. The loan was repaid at the end of the financial year, so that must be an outflow. So what we guessed earlier is actually true. 30 minus 20, of course, is 10. Prepare the cash flow statement for the year ended, etc. Exam point, be very careful with the, so exam point, take great care in calculating the profit before tax. Since statement of comprehensive income or income statement not given in this question, may well be in the exam, of course, make life easier for us. All right, so that's the exercise, the challenge that we face. My next challenge, of course, is to put together some kind of a meaningful answer. Don't look at the answer at the back. Let's see if we can write on a blank sheet of paper as we tackle a massive question like this. Basically, a statement of cash flow is receipts and payments. Receipts are inflows, payments are outflows, and that's all we're doing. So let's make a start on this then, as we get a little bit more done on our session. So let's start. Name of company, Radiance Limited. Let's do that. Statement of cash flow. For the year ended 31st December 2007. So let's keep 2 pages aside for this very straightforward exercise. Can you recall, please, the 3 categories that make this up? Did you say operating, investing, financing? So what's operating? Is that things like starting with profit before tax, adding back depreciation, etc.? In other words, the main operations. Don't forget that towards the end of that section, you have the easy source of some working capital marks. If your inventory goes up, you've paid money to buy some. If your receivables goes up, you've failed to collect, so you've lost money. And of course, if your payables goes up, they have actually financed us, so that'd be more like an inflow. So things like that make up the operating activities. The investing, always remember, is simply things like buying and selling non-current assets. Very straightforward indeed. And then the financing is where you have shares and debentures issued, repaid, etc. So one of the easiest topics in the syllabus, and so let's take it seriously and make sure we get lots and lots of easy marks. So how much space shall we leave? I'm thinking about 2 pages. What do you think? Should we go for 2 pages, just for safety? And on page 3, we can start doing some of our workings. So I'm going to go for at least 2 pages. If you've got big handwriting, maybe even more than that. So let's say a couple of pages kept aside for the cash flow statement. And on page 3, I'm going to go for the workings. So here we are, page 3, workings to radians. Not to be confused with the main answer. Now, one of the first things I'd like you to do when you're tackling, let's say for 1 minute, a huge question like this, is apart from having memorized the format, of course, being aware that one of the first things you must do is check out the overall cash movement. Is it up or down? Let's say for the sake of argument, it is an increase of 10 or whatever it might be. If you can establish that in the first few minutes, that becomes the total of your cash flow statement for this year. And so what I'm also saying is it's possible to search and find your answer because it's built into the question. It's the only topic I can say that about, where if you look around, you can actually find the total of the cash flow statement somewhere hidden in your question. And it's great to have the total in your question because all you're doing then is trying to work towards it. So that is the beauty of cash flow statements, provided you use this particular technique. So let's make a start then. The overall cash movement. The overall cash movement. No particular number. I'll call these dollars or thousands, whatever it might be. Perhaps I'll call these thousands. So have another read of the question, please. Okay, the overall cash movement. You might notice the opening and the closing. We're moving from left to right. Bonds held as current assets. Bonds held as current assets is 10 and 10. Then you have your cash, which is 3 and 16. So this is 13 and this is 26. And so the gap between these two is clearly an increase in cash of 13. So let's say, therefore, increase in cash, and cash was known as equivalence, equals 13. So it was 13 last year, and it's 26 this year, so it's doubled, so it's another 13. You know, this is the total of your cash flow statement. So let's say this is the total of the statement of cash flow for this year. Admittedly, you've got to bring in last year's and this year's, etc., etc. So let's break back to our cash flow statement. And towards the end of the second page, I invite you to put down these important figures. So here's my cash flow statement coming to an end, let's say. Towards the end of the second page, about 6 lines from the last bit, I'm going to say 13. And that 13 is the net cash flow for the year. And that, of course, comes from the movement in cash position. Cash movement in the workings. That came to 13 a couple of minutes ago. What you're also expected to do is to add to that the cash and cash equivalents at start of the year. Apparently that's 13, and so the closing is 26, all worked out by us a couple of minutes ago. So here we have the cash and cash equivalents at the end of the year. So that's the system. You first read the question very carefully, open up your big 2-page cash flow statement, go off to your workings, sort out the overall cash movement, drop that back into your cash flow statement, and now you know where you're going. Because that is the total that we're aiming for, 13. It is the only topic in the entire syllabus I can say that about. The answers and the question if you're prepared to look for it. Don't forget, though, all the time, I'm doing a big cash flow statement to make sure it makes sense to you. I'm introducing the concept, etc. But in the exam, you'll get little bits of this to do in rapid-fire succession. So you must be able to do it very, very fast, have some good quality workings. It is to those workings we're now turning our attention. One of the most difficult parts of this question, if not the most difficult part, is how you arrive at profit before tax. Clearly, without that, I have no chance in this question. Well, I might have some chance, but that is one of the first items I need to work out, if not the first. So how does one work out profit before tax where you have limited information as here? Clearly, that's a huge, huge exercise. So what I think I shall do is take you into the workings section and have a look at this challenge. Calculation of profit before tax. So this is my workings continued. Calculation of profit before tax, or PBT. Obviously, the closing accumulated profit is given as 68. The opening accumulated profit was 24. Therefore, for this year, the accumulated profit must be 44, also known as profit after tax for this year. If I can then add back the tax, which is clearly given, tax is given in the question, standing at, let's go have a look. if tax is given in the notes as 6,000, if I were to add back the tax, I suppose 50 is the profit before tax. PBT, profit before tax. And that is ideally the first line in the statement of cash flow. $50. You see? So there you are. Calculation of accumulated profit in the absence, or calculation of profit before tax using accumulated profit in the absence of it being gifted to you. Quite a major challenge that for a person who is less than well skilled. But we should have no problem whatsoever. The accumulated profit, as per the statement of financial position, at the end of last year was 24. This year, of course, is closing at 68. So how come 24 became 68? We must have made 44 this year. So whichever you want to show first makes no difference. If you feel you ought to put the opening first and then take away from that the closing, I'm just a bit concerned it might confuse you and you might think it's a loss. So especially as a relative newcomer to cash flow statements, I thought I'd be kind and do it slowly. So 68 is closing, 24 is opening, this year must be 44. But that is profit after tax, as indeed the figure that goes into accumulated profit must be after tax. And if the tax is 6, the profit before tax must be 44 plus 6, 50. And so we're in a position, therefore, to start our cash flow statement with the first item, which is obviously 50, the profit before tax.